One of the interesting findings that came out of the DLA Piper survey of technology executives was in response to our question regarding whether executives felt the impact of the current economic crisis would be worse than the impact of the burst of the technology bubble in 2000. Interestingly enough, 2/3 of the executives responded that they felt that the impact of the current crisis would not be as severe as the impact of the technology bubble burst. Of the group of respondents, about half of those who are more focused on venture capital, however, indicated that they thought that the current crisis would be more severe. We think the difference between the two groups was largely because of the emphasis on venture capitalists on exit issues such as M&A and IPO, which are likely to be more adversely impacted in the near term than longer term operating results. In general, we thought the reason why people focused more on the problems that resulted from the bubble was that the executives were focused on the fact that the bubble just focused on the technology sector, whereas in the current crisis, the impact on the technology sector is more residual because of the overall economic decline that's expected as a result of the current crisis. On an operating level, we also asked executives what their expectations were with respect to their performances. Almost 2/3 of the respondents indicated that they expected their revenues to decline as a result of the current crisis. More interesting than that, though, was that on other expense items, only 1/4 of the respondents indicated that they expected to be reducing their research and development expenses, and even a smaller percentage of executives indicated that they would be reducing sales and marketing expenses. This seems to indicate that the executives overall believe that the economic impact on the technology sector will be more short-term in nature, and that they wanted to continue to invest in the growth of their businesses with the expectation that the technology sector will rebound in a shorter period of time. Given the importance of IPOs to the technology sector, we asked technology executives as part of our survey as to what they thought the impact of the current economic crisis would be on the IPO market. Approximately 90% of the respondents indicated that they did not believe that the IPO market would return until at least the end of 2009. And over half of the respondents indicated that they did not think the IPO market would return until 2010 or later. This is not a particular surprise given the extent of the current economic crisis and the slowdown of IPOs that occurred following the tech bubble burst in 2000. In fact, after 2000, the first tech IPO was not until 2003. Turning to the overall question as to what is the reason for why technology IPOs have declined over the course of years, we asked executives what reasons they thought were most prominent. Approximately 1/4 of the respondents indicated that they felt that this was simply a cyclical fashion, such that if you look at technology IPOs over the course of years, you'd find that they come in certain periods and then they go away for certain periods. Another 1/4 of the respondents indicated that they thought it was more structural, relating to changes resulting from the costs associated with Sarbanes-Oxley compliance, as well as changes with respect to the roles that analysts can play in IPOs. But the largest group of respondents, approximately 1/3, indicated that they thought that the slowdown in IPOs is really a function of a change in the preferences of entrepreneurs and investors and venture capitalists, determining that it was, on balance, a better decision to sell with strong M&A exit opportunities rather than taking the risk associated with an IPO and building a young public company. One of the interesting consequences of this, of course, is that if more of the stronger companies that likely have the best IPO opportunities actually elect to choose an M&A exit, then the results of the companies that do IPOs on average are skewed downward, thereby potentially impacting future companies' decisions to prefer an M&A exit over an IPO.